Hi everyone, welcome to this live moment. As usual, I will share with you my views of the market, technically and fundamentally. The first thing I would like to say is, Donald Trump is the 45th president of the US, and what market chaos we were all expecting did not happen. In fact, it did, but it lasted like 2 minutes or something like that. Guess that his conciliatory words in his first speech has helped the market change its mind over the possible consequences of him being president. His word pointed for some inflationary measures which we actually don't know. We have to wait and see what will happen. At least, I don't know, the first 3 months of government, he will start in January. But overall, the market is optimistic, about what he did and what he said and what he may bring to the US. Let's see how the rest of the world take it and what actual policies he will implement beyond his wording before the election, the victory, and after that. Okay. Anyway, the other thing I would like to share with you, I now remember, is that it seems like the market has finally digested all this scenario, all this Trump president scenario, right? So ever since late Monday, we're seeing some stabilization in the market, dollar correcting a bit lower, stocks in consolidation. Overall, we are seeing most moderate moves across the financial world. That what we had over the past few days, indeed it was time to, and the market is now waiting for the next big trigger, which of course will be the ECB and the Fed on December, right? But well, anyway, let me share with you the macroeconomic calendar to see what we can expect for the rest of the week, and then we will take a quick look at the charts. Okay, I was checking what happened and what will happen before starting the webinar, and the first thing I noticed is that we're having a bit of disappointing Chinese data, right? That is waiting on the OC, but overall it's also helping stock pairing gains, because it's another sign of economic slowdown. Despite, if you take a look, retail sales 10%. Industrial production, 6.1%. These are huge numbers of growth compared to what we usually see in the US, Europe, or whatever other economy. Still, it's below market expectation, and it's somehow telling us that the economy is decelerating, right? So that it's affecting a bit sentiment, but not enough so far. What we had earlier today, and I do believe it's relevant, is that GDP in Germany has fell in the third quarter, 0.2% growth. That's a bad number. Germany used to be the country with most growth, leading the advance of the euro area. So somehow this poor 0.2% is telling us that all the effort the ECB is doing, it's worthless, right? It's not triggering any effect. We are not seeing any result to all these measures. So there's a good chance that the ECB will extend quantitative easing, the stimulus program, beyond March 2017, right? Now remember that Draghi's words are until March 2017, or as long as necessary. I guess it's time to change that date, right? At least that. I'm not sure if he will be willing to announce a rate cut, further rate cuts, or more stimulus, more helicopter money, sort of speaking, because lately he has been reluctant to do so, right? So the best thing he can offer to the market is extending the date beyond March 2017, and I'm not sure if that will help much the euro. In fact, I do believe that, as usual, it will be too little too late, right? So overall, I do see a gloomy picture for the poor euro. Anyway, and despite it's not linked to calendar, the market has also priced in our December rate hike, right? we are speculating that given Trump policies, the Fed will be forced, so to speaking, right, to rise rates during the December and probably a couple of times next year or a bit more if inflation actually picks up. So keep that in mind, right? The imbalance between both central banks, the ECB and the Fed, in the case it actually pulls the trigger, right? Will probably keep the euro dollar under pressure beyond intraday heights and lows. One thing that I do believe is quite relevant is that today we have October inflation data in the United Kingdom. Against expectations, inflation, in October fell right below September numbers and below expected. The retail price index also fell right below expected. But I was taking a particular look at the producer price index because we have this kind of greens and marks in the calendars because we usually understand that rising inflation is a good number, right? But take a look at this input prices, right? Input prices, the prices that producers pay, have grown by 12.2%. Output prices 2.1. That means that the history of a cheaper pound being good for local industries, it's sort of starting to play in against the UK currency, right? Because it's so cheap that importing base materials, whatever they need to produce, whatever they produce, it's being far more expensive, right? So this, at the end, should result in this picking up much more than what we are expecting, right? And what could the Bank of England do in that case? Because we have been cutting rates all across the world to rise inflation, right? So if inflation is higher, what did the Bank of England do? Rise rates at this moment with the Brexit around the corner? Pretty difficult situation for them, and not much tools to work with. Anyway, I still believe that what is going on in the pound is a very important corrective movement, but the movement seems to have faded at around 26. If we don't get above these recent heights, it will probably mean that the pound will probably go back to 120, right? In the long view. Anyway, for the rest of the day and today, focus will be on this. Retail sales in the US, a slight growth in October, moderate one, not really something shocking. So it could be a bit of disappointment. And if the readings are in line with these figures expected or even below, that will help the ongoing bearish corrective movement in the greenback to extend farther, okay? For Wednesday, employment in UK will be for the first thing to watch, right? It's generally expected, pretty much in line with previous month readings, quarter. Remember, this is the three months to September, 3 months to October, 3 months to November. It's usually the last 3 months reading when it comes to average earning and the unemployment rate. So it's not like we are comparing month over month, but what I'm trying to say is that we're not expecting much changes from September figures, the ones released, earlier November. So pretty much, unless we have a huge deviation here, maybe the report won't be enough to trigger some interesting moves in the pound. But let me take a look into Thursday, because I believe it will be the most interesting day of the day. We have employment in Australia, inflation in the euro area, retail sales in the UK, and inflation in the US. If there are a day where the macroeconomic data will give us a clear view of the health of the big economies, this will be, okay? I do believe that the focus, of course, will be in the US inflation, but I don't dismiss big movements in the Asian session following the release of the Australian employment figures. European inflation for me, it's not going to move much the market, not a couple of hours ahead of the US one, but indeed falling prices would probably uh, indicate that the ECB has the need to do a bit more in December and therefore widen the imbalance between both central banks, Europe and the US, and that will be probably euro negative. And if we have a positive number in the year, will be even more relevant. Okay, I would see that Gillian testified before the Congress, the Parliament, the Congress in the US, right? So we will probably get some clues on what's next for December in a year. I would pay a lot of attention to her words here now that Donald Trump is the new president. For what he has said so far, we understand that he is looking for a more aggressive Fed. So what will Yellen do? Listen to whatever he has suggested and take that more aggressive stance, or keep her uncertain, dovish, soft tone of usual, right? Keep that in mind. This could be a key market mover and set the trend for the greenback for the rest of the month. And we have Dragon speaking on Friday. I'm not sure if this will be related to economic currency and inflation in Canada. I don't see much going on Friday as usual. It will be a quiet day. We will have more interesting things going on afterwards. So let me change now and go to charts and see what's going on here. I was trying to find a trend line, a channel, another sign of Fibonacci retracement beyond the price action, right? And honestly, there's not much going on in the euro in that particular view, but indeed, remember we have discussed multiple times the fact that the pair has been trading between 840 and 1460, the top on here, right? With a couple of exceptions and moves away ever since early 2015, right? And what happened is what we broke below that level. So what's next for the pair? Well, as far as I can see, as long as that 840.50 region contains the upside, there's still room for a downward move. I do believe that we have a key support in here, which is 460 March 2015 low. I still can't see parity, but of course, if we break that level, the market will probably push the price towards that levels, okay, toward parity. Anyway, as I said at the beginning of the webinar, I do believe that the market has completely digested what happened last week with the US election, has digested also the Brexit and its consequences, and therefore we are having some stabilization in the market ahead of next big triggers, which of course will be central banks in December. But anyway, and for the short term, the immediate resistance is that 840 region. The pair in fact advanced up to this 4 hours bearish 20 simple moving average and quickly retrace. What I'm seeing intraday is that technical indicators have managed to erase the extreme readings but are back towards the downside, showing no actual buying interest around the pair. And of course, we have this low around 708 post yesterday. We have 701 from earlier this year. So below 700, I do believe that we have scope to go to 660 first, 610, and with little in the way down towards 460. Okay, and above 840, I do believe the movement could correct. The pair can correct up to 920, and still don't lose the bearish or negative trend. Although, if we advance above this level, there is a good chance that the pair can retest 110. not seeing much of a reason for the pair to go this high, but I want to share the levels with you just in case. We always have to look both ways around. Okay, and this is the pound, as we were discussing earlier. It reached the 26.7, almost 27 region, past 27, but it was unable to hold gains and slowly turning south. As I told you, inflation was not actually too encouraging today, so that is helping the negative momentum, but it will depend on US retail sales. If that is disappointing, the pair will probably hold. Anyway, for me, the key is this 23.20, 23.30 region. We have multiple highs and lows around that level, and approach. Once we broke above it, an approach to the area was quickly reverted. So overall, that's the level to watch during the upcoming days. If a pound breaks back below that level, there's scope to go back to 120.80, this low. Okay, yeah, October 25 low, and below that level 120. The short term today's low, it's around 23.90, so that's my immediate support. If we break below it, 23.30 comes next, 22.90 then. There's some sort of short-term resistance around 24.40. Take a look. We have multiple highs and lows from this past few days. Above that level, we can go up to 24.90, 25.20. But I would expect this last to hold, right? If below 25.20, the risk will run to that towards the downside. Sorry. And for dollar Japanese yen, whoa, what a ride! that's with the dollar Japanese yen. No pullbacks, no looking back. Once it gets into a trend, it starts to move. On the daily chart, it has broken above the 100 moving average, tested 200, broke above it, and here we are. There's a line in the sand around 106.60. I do believe we discussed this multiple times, and over the past few weeks, and the fact that the pair has settled above it has opened doors for an advance towards the 110 region, right? I do believe that it's likely. I do see the pair now more bullish, although if you take a look at intraday charts, they're slightly overbought, so maybe some consolidation until indicators settle. Anyway, 107.70 is the lows we have seen so far. So below that level, I could expect a downward corrective movement. 107.30 comes as the next support, and that 106.60, of course, will be the key, right? The pair will need to break below it to the night and upward extension. Okay, and above that high, as I said, 110 seems the next probable bullish target for me. The other thing that seems quite interesting is the Australian dollar, although not that much. This is my daily chart. If you take a look, it has been finding buying interest around the 38.2% retracement of this year rally at around 74.50. So here we have the base of the range, and all those spikes beyond 77 were quickly reverted, as you can see. Also for a couple of months, a long couple of months already. So we have a well-defined range in here, and despite this dollar strength and commodities weakness and whatever is going on, the pair really needs to break that 74.50 level, right? Or really engage into a rally. At this point, I could say that despite 77 is the top of the range, the pair will need to break above the year high of 78.30 to actually get into a bullish longer term trend. Seeing right now, it's a consolidated phase. We have those 300 pips range, and I would keep on trading that range. Okay, I believe that trading in between those levels has been pretty good idea for the past months and will remain so. We have this lows around 75.20 this week, another one at 75.06. So if the pair breaks below this one, there's a good chance that it will approach to that 74.50 region. I still can't see a break below this level unless we start to get really bad news for coming from Australia, which we are not getting, and good ones in the US, which, yeah, we are getting good, but not stunning good news. So I don't see it a break lower yet. Okay, not yet. Anyway, 77 is the main resistance now. Above this level, the pair can recover some ground. 76.40 is for me the next resistance. 77, of course, and above that level, in between 77.30 and 77.70, market will probably start selling again. This is my weekly crude oil price charts, right? The commodity is recovering some ground after testing 42. I draw this 42.52 region because I do believe that's sort of a comfort zone for the price, right? And if you take a look at the weekly, we have been comfortably there for 3-4 months last year. The break lower we had at the beginning of ends of 2015, beginnings of 2017, and then back to that comfort zone. We're expecting the OPEC, to meet by the end of this month, right? And of course, the recovery was triggered. The latest one, at least this one, was triggered by comments coming from the OPEC saying that they will cut their oil production. But ever since that said that, oil news, record production, record exports, rising stockpiles. So actually, it seems that they are talking about something they are not doing. Anyway, I don't see the commodity breaking below 42. I do believe that the market, with that, the past 3 weeks slide, has pretty much priced in the non-action coming from the OPEC, right? So here we are in a comfort zone, and it seems unlikely we can break out of it unless the global glut starts to actually reduce, or they announce real pact to cut production, right, and to do something else to stabilize the markets. Anyway, said so. There's a slightly positive tone in the commodity right now, although if you take a look at the daily chart, the 20 simple moving average is aiming to cross below the 1 and 200 ones. If the price does retreat today and it's unable to close above 45, there's a good chance that it will turn back lower, back to this 42.50 region. And over the next few days, we may see the price falling as low as 39 before recovering some ground, right? At the close above 45, on the other hand, will probably favor an upward corrective movement. Remember, we have stockpiles in the US in the upcoming sessions, so maybe that will, if the stockpiles are lower or get reduced, we will get some short-term boost in here, and we can go towards the 46.60 region. But honestly, I do believe that we are going to see the middle range over the upcoming days in oil ahead of a meeting later this month. And for gold, yeah, I draw a line in the sand around 1200 because I do believe that if we lost that level, we can go back towards this late 2015 lows in 1050, right? Although I'm not expecting those prices to hold for long, because that will be too close to production costs, and that will reduce production. If we get that low, producers would start to pair activity. Therefore, demand will be increasingly more than offer, and probably prices will bounce beyond speculative interest. Okay, it's not a speculative interest. Sorry, it's not the only thing that moves the market. Anyway, the negative stance persists. There's little room towards the upside. I do believe now that approaches to 1245 could be seen as selling opportunities in the market, particularly if the market remains convinced that the Fed will raise rates in December, right? Uh, Somehow that scenario changes or the Fed stays on hold, that will probably favor further recoveries in oil, but gold, sorry, but we are too far away from that. Short term, 1245 for me, it's like a lot in the sun. If we get above it, then the corrective movement will become stronger and it can go up to 1270, 1275, not much more than that. On the other hand, if we lose this low, 112, it's the what 1200 is the next support. And if we lost that one, I would expect the selling interest to accelerate, right? Market keep on and winning its long positions in here and pushing prices up around $50 lower, 1150, 1160 is the next probable bearish target. Sorry. Okay, sorry guys. Uh, um, uh, that's it for today. It has been nice to be here with you as usual, and hopefully see you back next week. Okay, thank you. Bye bye.